Hello friends, welcome to my new blog, and today we discuss about the capital structure part 2. First of all, we discuss about the simplicity of capital structure. An appropriate capital structure should be easy to understand and easy to operate. For this purpose, the number of type and securities issued should be limited. Decision include in capital structure, type of capital structure and securities to be used or issued, and ratio or proportion of securities. Capital structure includes the following decisions that I mentioned right now. Type of securities to be used or issued: shares, equity shares, preference shares, debts, debentures, bond, public deposit, loan from bank and financial institutions. Ratio or proportion of securities. The ratio or proportion of securities in any capital structure is an important decision. The decision of capital mix is called capital gearing. The capital gearing may be high, low, or even. When the proportion of equity share capital is high in comparison with other securities in the total capitalism, it is low geared, and in the opposite case, it is high geared at the same time. If equity share capital is equal to the other securities, it is called evenly geared. Now, capital structure importance: maximizations of returns to owners, minimizations of risk, increasing value of firm, proper utilization of funds, and more that I discussed right now. So, capital structure decisions of a firm have to a far reaching impact on different aspects of a firm operations and long term growth. Capital structure significantly affects the return to shareholders, cost of financing, and most importantly, the value of the firm. In addition, it casts a great impact on the existing ownership structure and associated control also. Now, the importance, the maximization of returns to owners. A properly designed capital structure offering a judicious use of mixed charge capital and owned capital can maximize the return on equity. This is because a firm with a rate of return on assets higher than the cost of debts and cost of preferential capital can significantly increase the return to shareholders by increasingly the proportion of debt and preferential capital in its total capital, even in the absence of taxes. In the presence of tax, increase is found to be even higher, as interest on debts is a tax deductible items, and as results the resultant tax savings goes to the equity shareholders. Now, importance to maximization of cost of capital. Cost of debts is generally found to be cheaper than cost of equity. Moreover, it is also range bound. It is too easy say it remains relatively constant within a given range. As a result, an increase in the proportion of debts capital keeping the total capital unaltered contributed or contributes significantly to reduce the overall cost of capital. Hence, an optimal debt equity mix in a capital signature or structure can minimize the overall cost of capital. Now, importance 3: minimization of risk. A business is subject to two types of risks: business risk and financial risk. Business risk arises from factors like sudden fall in demand, falling prices of goods, non availability of raw materials, etc. On the other hand, the financial risk arises due to inclusions of fixed charge capital in the capital structure also. Now, since a proper balance must be maintained between these two risks to minimize their overall impact, capital structure can play an important role here. thus a firm with high business risk resulting in higher variability in operating income may use lesser debt to reduce the impact of financial risk and vice versa to balance the overall profile of the firm also. Now the importance number 4, increasingly value of the firm. Value of the firm, or more precisely market value of the firm, largely depends on its performance, since properly designed capital structure can significantly reduce the overall cost of capital return to shareholders increases. This, when recognized by the market, improves the market price of shares and accordingly the total value of the firm. Importance number 5, ensuring liquidity. The capital structure of any firm has significant bearing on a firm's short-term and long-term liquidity in terms of buyback of equity shares, redemption of preference shares and debentures, repayment of loan and payment of dividend and interest also. A properly designed capital structure commensurate with earning and cash availability takes care of these factors and ensures liquidity. Important 6, preservation of control. In many situations, large borrowing come with certain debt convent, that is restrictions imposed by lenders. As a result, debt providers interfere in major company decisions and absolute control by equity shareholders is compromised. A well-planned capital structure keeps a balance between equity and debt capital and thereby preserves the control of owners in the company. Importance number 7, proper utilization of funds. So a ideal capital structure always take into account the actual reason behind a fund procurement decisions, thereby establishes proper coordination between the quantum of capital and financial need of the business. As a result, both undercapitalism or capitalizations and overcapitalizations can be avoided in organizations. Now importance number 8, financial or financing long-term growth. So firms' existing capital structure plays an important role in attracting finance for long-term expansion on growth programs. A firm with sound capital structure get finances both in form of issue of shares or raising new debts easily compared to a firm with unplanned capital structure. Capital structure top essentials. The management of a company should try to develop a capital structure which is most advantageous for the company and its equity shareholders. It should aim at maximizing the long-term market value of its equity shares. A sound capital structure must possess the following essentials that I mentioned right now. Essentials number 1, economy. A capital structure must ensure the minimum cost of capital to enable the firms to generate more surplus and wealth. Essentials, clear-cut objectives. A capital structure of a company should be guided by clear-cut objectives. It should aim at maximizing the long-term market prices per share as far as possible. Essential balances. The capital structure should represent a balance between different types of ownership and debt securities. This is necessary to reduce risks on the use of the debt's capital. Essential flexibility. The capital structure of a company should be capable of being adjusted in accordance with the changing condition within minimum cost and delay. It should be continuously revised as per the changes in the business conditions. It should also be possible for the company to provide funds whenever needed to finance the profitability ventures. Now, essentials, Number 5, control. The capital structure should involve minimum risks of loss of control the company. The dilution of control is a major problem for the management of closely held companies. Now, safety. The sound capital structure should ensure safely on investment. It should be such that the fluctuations in the earning of the company do not put stress on its financial structure. Dynamic. The capital structure should be revised periodically depending upon the changes in the business conditions. The company should have the capacity to repay its debts and reduce interest obligations also. Capital structure aspects, profitability and liquidity aspects. The two aspects have been analyzed in the following paragraphs that I mentioned right now. Profitability and liquidity. A firm has different options regarding the combination of various sources to finance its projects. The cost of finance varies or depending on the source of finance because there is no fixed cost in any of equity. Interest on debts, besides being tax deductible or carries a fixed charge, divided on preference shares. In case of equity dividend paying firms is a fixed charge. Now, analysis is an analytical mechanism that seeks to examine the effect of financial alternates on EPS for different levels of EBIT. Thus, different financing patterns shall have different EPS for a given levels of EBIT. So EPS reflects a company's net income. So dividend divided by the numbers of shares outstanding. And it reflects operating income because it is the amount of profit that remains after adjusting all operating expenses, that is interest and taxes, are excluded. These basic objectives behind every financing plan is to maximize the earning per share. Now, these relationships is linear as all the values interest, preference, dividend and number of shares are given for each other financing methods and the tax rate is assumed to be constant. Therefore, EPPS is computed for two different levels of EBIT. For each financing method, the line representing each financial plan can be obtained. Now, the ignorance, the risk factor. Leverage increase of the level of risk, but the risk factor as the debt components in the capital structure increases. The financial risk faced by the shareholder also increases. So the EBIT or EPS analysis fails to deal with the variability of EPS and the risk returns trade-off. Now overemphasizes on EPS. The EPS is computed from the operating profits so that it is more an indicator of operational performance also. It may not be the correct basis for a capital structure decisions also. Inconsistent results. If the firm has to decide between alternatives financial plans that do not consist of the issue of the equity shares, EBIT EPS analysis shall not help in making capital structure decisions. For instance, if a company wishes to raise finance either by the issues of preference shares or debts finance only, EBIT or EPS lines of the two plans drawn graphically will be parallel and no intersection point shall emerge. This implies that there is no indifferent levels of EBIT for the two plans. In spite of the shortcoming of the EBIT or EPS analysis, it is considered to be an important mechanism in capital structure decisions making also. Now, the coverage ratio measures the margin of safety a firm has for paying fixed charges in the form of interest and preference dividend during a given period. A firm needs this margin of safety in order to survive during any adverse economic conditions. The lower the coverage ratio, the higher is the firm's debts burden and greater the possibility of bankruptcy or default. A higher ratio indicates a better financial health, as it means that the firm is more capable to meet the fixed charges from the operating earnings. It may be calculated for various levels of EBIT. This gives a better picture of the firm's most likely EBIT to meet its commitments also. Now, a firm's ability to meet its financial obligations is an aspect of the firm's solvency and is thus a very important factor in the return to the shareholders. Now, EBIT and EPS analysis and the coverage ratio both emphasize the importance of the profitability of designing the capital structure of a firm. It is possible that the firm has adequate EBIT to meet its debt obligations, but may not have sufficient cash to make the actual payment. Such a situation may arise if the income of the firm is blocked in receivable inventory and so on. Also, the firm should not also be only be the capable of meeting the interest and dividend or dividend payment. It should also have enough cash flow for the repayment of debts or redemption of preference shares as and when they become due. Therefore, it is important to consider the liquidity aspects along with the profitability aspects of the firm in order to make sound capital structure decisions also. Now, cash flow analysis, liquidity aspects. Cash flow analysis measures a firm's ability to meet the fixed obligations like interest, principal amount of debts, and dividend on preference shares and their redemption and so on. If a company employs a higher proportion of fixed charge finance but does not have sufficient or stable cash flows, it may face financial distress leading to insolvency. Hence, the liquidity aspects is an important consideration to determine the firm's ability to make timely payment. Now, the liquidity analysis is best achieved with the help of cash flow information, as it is more reliable than a balance sheet or income statement information. It includes analysis of the generation of and use of cash from operating, investing, or financing activities. Now, operating cash flow. This relates of cash flows from day-to-day operations of the business. They are determined by converting the items reported on the income statement from accrual basis to cash. For instance, cash received by disbursed for product sales, loyalties, commissions, payroll, and so on over the period of analysis. And non-operating cash flow. These constitute the payment made to acquire long-term assets, cash received from their sales, and working capital changes. These are non-recurring in nature but important for maintaining the operational efficiency of a firm. For instance, the purchase of fixed assets and the purchase or sales of securities issued by other entities is non-operational transactions. Now, financial cash flow. This includes financial obligations of the firms that have to be paid as when they fall due. For instance, interest, repayments of debts, dividends, and so on. The analysis of different components of cash flows gives a clear picture of a firm's ability to meet its financial obligation. In favorable as well as unfavorable economic conditions, Thereafter, the firm is in a better positions to decide the debt's equity proportion in its capital structure. So fixed charges and to net cash inflow ratio. Now we discuss about this. This ratio compares a company's available cash resources with its current interest principles and other fixed financial obligations also. It is a debt service cover ratio and it indicates the number of times the fixed financial requirements are covered by its net cash flows or inflows. A higher ratio indicates higher debts contents in the capital structure. This also has a bearing on the firm's debt capacity, and that is this ability to borrow. Cash budget. A cash budget may be prepared to find out the expected cash flows, inflows, and cash outflows, including interest and repayments. Now, cash flow forecast aims to predict future further financial liquidity over a specific period of time. The cash flows that are forecasted for operating, investing, and financing activities should be adjusted for the risk factors associated with cash inflows as well as cash outflows. The deviation between the actual and unexpected cash flows may arise due to many reasons like increased competitions, inflations, and increased fixed charges. Therefore, the companies prefer to make cash budget for a range of possible cash inflows, giving due consideration to different operating conditions also. Such projected cash budget help the finance manager to access the liquidity capacity of the firm and design the capital structure accordingly. The designing capital structure evaluates different aspects of the capital structure. The EBIT or EPS analysis stresses the profitability of the proposed financing mix and analyzes it from the point of the view of capital shareholders, equity shareholders. The cash flow analysis stresses the importance of liquidity in debt financing and thus it emphasizes the debt servicing aspects of financing. Now lastly we discuss about the capital structure significance or benefits. The significance or benefits capital structure are as now discussed right now. In the area of the financial management capital structure, decisions are of the utmost significance, but some companies do not plan their capital structure. These companies may be able to succeed in the short period, but they may feel difficult to get necessary finance for their activities in future. So, therefore, for the maximum profitable use of resources and to adjust according to changing requirement, planning of capital structure is necessary. Management can determine the optimum capital structure by proper decisions on the capital structure in which the aggregated cost of capital is minimized and value of ordinary shares is maximum through the right decisions on the capital structure, and management can increase the return for its shareholders by using financial leverage. Management can determine the debt capacity of the business by not fully utilizing the debt capacity. Firms can be saved from the financial distress if a company has growth opportunities in the future. Additional finance can be raised at the right time. Firm can save itself from the restrictive conditions of the financial institutions at the time of loans, etc. If a company uses more debts in its financial structure, It increases financial risks. In a result, the debts and share capital in future is available at high cost. Financial risks can be kept at an appropriate level by proper decisions on the capital structure. Now, pattern of capital structure is the various combinations of forms of capital resources for a newly formed company, as you all know, which is preferred by the company based on its requirement or preference. Capital structure with equity share capital only. Capital structure with equity share capital and preference shares. And capital structure with equity shares capital, preference share and capital debenture. Capital structure with equity share capital and debenture. For an existing company, the same patterns of capital structure are used by substituting equity capital for debenture share capital. Now, the selections of an appropriate pattern of capital structure is governed by a number of factors such as amount of capital required and nature and size of business enterprises, regularity of earning, cost of financing, conditions of the money market, and the attitude of the investors also. Now, a company can raise fixed capital without creating a charge on the asset of the company. Equity shares do not impose any fixed liabilities like assured rate of dividend on preference shares or interest on debentures. The directors have greater discretions on declaration of dividend. In this regard, they can protect the interest of the company by creating reserve and surpluses out of the uh, divisible profits. Or equity share capital attracts bold, adventurous, or speculative inventors with more profits and controlling power. Like debenture, there is no obligations to return the money raised as capital, equity capital. Now, about the demerits, cost of financing equity share capital is relatively more. Companies cannot enjoy the benefit of trading on equity. Equity share capital does not attract cautions investors because they prefer safety of investments and stable dividend. Excessive issues of equity share capital may lead to over capitalizations if the earnings does not justify the issues. Management may lose grip over the affairs of the company if at all the funds are raised only by equity shares. Now, this type of capital structure attracts both bold adventurers and cautious inventors or investors. Bold adventurers or investors will go in for equity share capital as they are ready to take risk, while caution investors would buy preference shares with fixed dividend. The inclusions of both equity and preference shares in the capital mix ensures the greater flexibility in the capital structure. Now, the company can raise preference share capital without creating charge on its assets. Preference shares will have better demand because equity shares will provide a sound base for the issue of preference shares. Control of the company's affairs will be vested in equity shareholders, while preference shareholders do not enjoy such rights because they are non-voters, and to some extent it facilitates trading on equity. And these schemes is costlier compared to the issue of the debenture. If effects of the interest of the equity shareholders because they get their dividend after payment of fixed dividend to preference shareholders, company cannot enjoy the advantage of the trading on equity at fuller extent. There is profit possibility of exploitations of the preference shareholders. Cumulative preference shares may impose the liability of payment of accumulated dividend also. And redeemable preference share increase the liability of repayment. So that's for the video, my friends. If you like my videos or blogs, thanks for please subscribe my channel and share and comment on my vlogs. Thanks for watching my videos.